Hi there, welcome back to the channel. Today we'll be talking about nacho. Wait, not this nacho. Put this away. Not a chance Hormuz opens. Yes, that's the one. Or will it open? Let's dive straight in. Imagine the world's most important highway suddenly turning into a parking lot. Now imagine that parking lot is surrounded by naval destroyers, sea mines, and a whole lot of geopolitical side-eye. That's the Strait of Hormuz right now, 21 miles wide, and yet somehow the biggest bottleneck on planet Earth. If global oil supply were the line outside a nightclub, the Strait of Hormuz is the only entrance. Right now, that door is jammed, the bouncers left, and half the guests are arguing about who's in charge while the other half just want to go home. For months, this critical artery has been more blockbuster disaster movie than functional trade route. We're asking the juicy question: what happens when it finally reopens? Do all those super tankers just fire up their engines and sail off into the sunset like the end of a Fast and Furious film? Does your gas bill magically shrink? Spoilers. Not exactly. We're talking trapped sailors, overflowing oil tanks, naval standoffs, insurance bills that could make a tech billionaire cry, and a permanent shift in how the world moves energy. Buckle up. This is going to be a ride. The current situation. It's mid-May 2026, and the Strait of Hormuz is basically the world's most expensive parking lot. It is a sea of standstill. There are an estimated 2,000 ships and around 20,000 seafarers trapped inside the Gulf. That's basically a floating city's worth of people. Before the war, over 100 vessels a day cruised through the strait. Now, that number is down to single digits. We're living through the biggest oil supply disruption in history, with roughly 1 billion barrels cut off from global markets. To compound the issue, oil is not just the only vital export that sails out the strait. Qatar and the UAE account for roughly 20% of global liquefied natural gas exports, and there is no transport alternative for the Strait of Hormuz. A third of the global helium supply also flows through the strait. This is a critical component used for semiconductor manufacturing. What should scare you even more is that a third of the world's urea, used as fertilizer for global food supply, comes out of Hormuz too. Time to stock up on some food? But behind those staggering numbers are actual humans, and they're not exactly having a spa day. Imagine being stuck on a giant metal box for months, knowing that a missile could turn your workplace into a fireball. One crew member reported that after a nearby tanker was hit, 90% of his shipmates said they'd refuse to transit the strait even if it reopened. That's not just a logistics problem, that's deep, visceral trauma. These sailors have binge-watched everything on Netflix twice. They've seen more "Are we there yet?" moments than a cross-country family road trip, except with way more explosions. This human fear factor is a huge deal and will slow down any so-called return to normal. The Great Un-Gridlock. So a ceasefire is announced. The shooting stops. Time to party, right? Not so fast. This isn't a light switch. We saw this movie already back in April when a brief and very fragile reopening attempt happened. More than 20 ships started their engines, moved toward the exit, and then nothing. Right back to port when things still looked sketchy. Now, even with a tentative lifeline open, we only see a few brave supertankers making a run for it, mostly carrying Iraqi crude, often sailing dark with their transponders off to avoid attention. This ghost fleet is the high-risk first wave. There will most likely still be loads of red tape. Passing vessels coordinate with a new Persian Gulf Strait Authority and potentially pay tolls of millions of dollars. Major shipping lines like Maersk have said, "Yeah, no thanks." Their crews are terrified, mines are still lurking, and the legal and insurance picture is murkier than a foggy night in a horror film. The first phase of a Strait of Hormuz reopening isn't a triumphant homecoming. It's a weeks-long escape room challenge where the prize is simply not getting blown up. Storage problems. This shipping paralysis didn't just stop tankers, it backed up the entire Gulf's oil production in the messiest way possible. Imagine your bathtub faucet is running full blast, but the drain's completely plugged. Eventually, you're going to flood the bathroom. Analysts at JP Morgan Chase warned that Gulf producers only had about 25 days before their storage tanks would overflow, forcing them to shut down the taps. And that's exactly what happened. Iraq, which sends almost all its oil through Hormuz, hit its storage limit and had to declare force majeure, a fancy legal way of saying, "We literally can't pump anymore, this isn't our fault." Production crashed from 3.3 million barrels per day to just 900,000. Kuwait is another sitting duck in this crisis. Unlike other Mideast countries, they have no alternate pipeline or access to the Red Sea to reroute their oil supply. With no other way to export its 2 million barrels per day of oil, Kuwait was also forced to declare force majeure in March. What about oil rigs? Yep, many had to shut down too. Iran's Karg Island terminal, their export lifeline, is now racing against the clock with only 12 to 22 days of spare capacity left before they must start shutting in wells, a technical nightmare that can permanently damage reservoirs. When the strait reopens, it's not just flipping a switch. It's a slow, delicate process of restarting wells without breaking everything. So, is it possible? Short break before we move on. If you find this kind of content interesting and useful to you and want to learn more about finance, businesses, and how the global economy works, please help support us by liking this video and sharing it. Also, be sure to subscribe so you don't miss the next video. If you would like us to cover some topic, drop a comment below. Thanks for staying with us, and now back to the video. Geopolitics, a high-stakes standoff. The military side of this is like a game of chicken played with billion-dollar hardware. The US response, dubbed Project Freedom, because the Pentagon loves a good brand name, isn't a close bodyguard escort for transiting ships. Instead, it's more of a we'll-be-in-the-neighborhood type, warships stationed nearby to deter Iranian attacks and offer navigational help if needed. Iran's reaction? Unsurprisingly, not a warm welcome. Their Navy has fired warning shots at US ships and flat-out rejected the idea of an American-led escort, insisting that any safe passage must go through them. And they're not just posturing, they've tried to normalize a toll system, demanding fees up to $2 million per ship to pass. This is basically a maritime protection racket, and even China and the US agree it's a terrible idea. Clearing the Strait of Hormuz also adds a dangerous, months-long phase to any reopening. So even with a ceasefire, we've got two navies side-eyeing each other across the water like rival contestants on a reality show, each convinced they are the hero. The risk of a sudden reclosure is sky-high. The invisible blockade. Now, here's where it gets genuinely wild, and probably the most important thing you haven't heard about. The strait can be physically open but commercially dead, all because of one thing: insurance. This is the invisible hand that can shut global trade faster than any missile. Before the conflict, getting war risk insurance for a supertanker passing through Hormuz cost about 0.2% of the ship's total value, including all its cargo. That equates to about $500,000 per voyage for a supertanker carrying 2.5 million barrels of oil. A rounding error for these companies. Today, insurance premium has climbed to between 1.5% to 3%. For the same supertanker, insurance costs would spike more than 10 times to $7.5 million. Here is the fun part. It is said that American, British, or Israeli-linked vessels are being charged even more, up to 5% of the ship's total value. That's not just a price hike, that's a "we need to sell a kidney" kind of moment. Lloyd's Market Association, the big brains of the insurance world, says a simple ceasefire won't magically drop these rates. The region now carries a lasting risk premium. Think of it like this. Your home insurance doesn't go back to normal the day after a flood rips through your neighborhood. So even if the shooting stops, the economic blockade, driven by pure, spreadsheet-calculating terror, will keep trade sluggish and expensive for years. The first tankers and the new normal. So let's say we're willing to pay the hefty insurance premiums. When those first brave tankers finally crack open the exit door, where are they heading and how fast? The initial lifeline goes to the nearest energy-hungry customers. India gets a delivery in just 5 to 7 days, basically express shipping for crude due to their geographic closeness. Japan and South Korea wait about 20 days. China about 22 to 25 days. Europe faces a marathon 35-day journey, likely going all the way around Africa because the Suez route still feels like driving through a haunted house. The physical backlog of ships might clear in a week or so, But end-to-end delivery takes weeks before you see any change at the pump. On top of the month-long journey for the supertankers out of Hormuz, that raw oil still needs to be refined before you can use it. With many refineries shut or operating at lower capacities right now, reopening and ramping them back up will need another 45 to 50 days. And of course, another round of shipping to deliver the refined products to where it is needed, adding perhaps another 30 days on top. That brings the total to almost 4 months before you see any supply of the oil products that were cut off. And that burning question, will oil prices be forever higher? Near term, expect chaos. Analysts at Fitch and the US EIA see Brent crude bouncing around $100 to $110 per barrel during the crisis, with spikes possibly up to $150 per barrel. Although thankfully, we haven't seen such a dramatic spike yet. Touchwood. JP Morgan expects Brent prices to be sticky, staying in the low 100s in the months following any reopen. But long-term, as production comes back and stockpiles rebuild, Fitch sees prices falling to $70 per barrel. So no, they won't be higher forever, but the days of cheap, carefree oil are over. A permanent risk premium will be baked into every barrel you buy, like a tiny, annoying subscription fee for global tension. To sum things up, what exactly will be the new normal? It's a world reshaped by the ultimate teachable moment in chokepoint vulnerability. First, that permanent insurance surcharge we talked about, it's not going away. Second, countries and corporations have learned their lesson and are now rushing to diversify supply. They'll strike deals for oil from the Americas and Africa, routes that take 40 days instead of 20, tying up tankers and bumping baseline shipping costs forever. And third, we'll see a boom in mega projects to bypass Hormuz entirely. New pipelines, LNG terminals, and wild ideas like India's proposed subsea gas pipeline. In short, the reopening of the Strait of Hormuz isn't a happily ever after ending. It's the first wobbly step into a pricier, more paranoid energy world. Thanks for watching. If you want to stay ahead of the curve while avoiding actual sea mines, hit that like button. Comment what you think. Are you feeling the pinch on fuel prices where you live? Don't forget to subscribe if you want more. See you on the next one.